Hi, this is Nashima, the CEO of InfoTechSquare.com and the Gleim Lab Professor. I encourage students and professionals to sign up with Gleim to enhance their knowledge. I'm using Gleim for years and years, and I'm quite satisfied with their products and customer service. I also encourage all the users and visitors to subscribe our channel. Why should you subscribe our channel? Because we develop content based on the Congress sections and IRS publication, and we are the team of the EAs and CPAs. My today's topic is about taxpayers benefit from the investment of ISO and NSO. ISO stands for incentive stock options and NSO stands for non-qualified stock options. So I'm going to start with the characteristics of incentive stock options and non-qualified stock options. The right to purchase stock at a specific exercise price at some point at the time is granted by stock options. The purpose of vesting period is to prevent employees from exercising stock options right away, as it aims to create long-term value and align incentives. Equity compensation can come with tax advantages when using incentive stocks option ISO or qualified, which is also called we also call it statutory or stock options. The aim of this to balance employee interests with company performance and provide favorable tax treatment under the Internal Revenue Code IRC. In order to receive ISO treatment, stock option must meet the following restrictions. When the company issue ISO, there are restrictions so that the employee can which the employees must comply with those restrictions. Number one, the purpose of these is solely for employees. Number two, at least 2 years after the grant date, the options will vest. Number three, it is necessary to hold the option for at least 1 year after the exercise date. Number four, after 10 years, the options are subject to expiration. Incentive stock options do not recognize income at the grant date or even at the exercise date for regular tax purposes. Income is only possible when you sell the stock, and it is determined by whether you meet the specific holding period requirements. Upon holding the gains for the required period, they are considered long-term capital gains and they are often taxed at a lower rate. The exercise date is not taxable for regular tax purposes. The alternative minimum tax or selling the share can result in a potential tax impact. The nature of taxable income is determined by the sale timing and whether you meet the holding requirements, which can be either long-term capital gains or ordinary income. When purchasing ISOs, the cost basis is the strike basis or exercise basis, which is the amount paid to buy the stock. When selling stock, the basis becomes vital in calculating your capital gains or losses. If you exercise your option at $10 per share and then sell it $50 per share, the difference in price will determine your capital gain. The bargain element that is not taxable is the difference between the ISO's exercise price and the market price during exercise. Although it is not considered gross income for regular tax purposes, it still causes an AMT adjustment. This is one of the tricky areas where something that is beneficial for regular taxes could be problem for AMT, alternative minimum tax. Alternative minimum tax is basically an additional tax is imposed by the IRS if you cross the cap of certain limits. That we will also discuss later in this topic. So when selling the shares, the difference between the sales price and the exercise price of the stock is considered a capital gain or loss. The gain's nature, whether it is short term or long term, is determined by how much you keep the shares after exercising the option. Hold the stock for more than a year after exercise and 2 years after the grant date, and any gain is treated as long-term capital gain, which generally enjoys a lower tax rate. A short-term capital gain can be attributed to holding it for shorter period, which will be taxed at your regular income tax rate. Equity compensation is a form of non-qualified stock options, which are also known as non-statutory stock options. Non-qualified stock options do not meet the specific requirement to be classified as ISOs. The tax treatment of these individuals is influenced by this classification. Ordinary income is immediately realized when you exercise NSOs by comparing the exercise price to the fair market value of these stocks. At that time, income tax and payroll tax are imposed on this income. Any gain or loss experienced when selling the stock after exercising is categorized as capital gain or loss. Short-term or long-term status is determined by the holding period after the exercise. Ordinary income rates are applied to short-term gains, while long-term capital gains are benefited by the lower capital gains rates. NSOs offers greater flexibility in their design, but they are immediately taxed upon use. Income is not recognized when options are granted with NSOs. When you exercise your options and then sell the shares, you will face tax consequences until the options are exercised and the shares are eventually sold. It is likely a deferral. After the exercise date, the bargain element is recognized as ordinary income. The fair market value on the exercise date is the basis. Let me explain it with an example. Frey Corp grants Jano 100 option with $5 per option on April 1st, 2021. After the options vest, Jano exercises all 100 options on July 10, 2023 at the strike rate of $15 per share. The market value is $18 per share. Jano holds the share until selling them by August 18, 2024 for $22. How much income will Jano recognize if the options are ISOs, incentive stock option, and when will Jano recognize it? And the second question is, what is the options are for non-qualified stock options and NSOs? An illustration of the income determination for ISOs and NSOs can be found here. Number one, neither the incentive stock option nor the non-qualified stock option receive income recognition on grant date, which was April 1st, 2021. Number two, there is no income from the incentive stock option and stock options on the exercise date. Conversely, in non-qualified stock option, there is an ordinary income of $300, which is the recognition of grant price subtracted by the market price. Number third option is whereas in non-qualified stock option, there is a long-term recognized gain of $400, which is the combination of selling price minus market price. Now we have to find some definition of the keywords which we have been using, which we'll be using in this topic. So we must know the definition of such keywords. What is a strike price, which we have earlier used in this topic? So what is the strike price? The strike price is essential in option trading because It determines the price at which an option can be used, regardless of the market price of assets in question. How is an incentive stock option different from non-qualified stock option? Now we are going to present a comparison between ISO and NSOs. Incentive stock option ISOs and NSOs have significant difference in their tax treatment and eligibility. If ISO held for the required period, which is at least 2 years from the grant date and 1 year from the exercise date, the profit on the sale of the stock is taxed at a long-term capital gains rate, which is generally lower than ordinary income tax rate. Ordinary income is used to tax the difference between the exercise price and the fair market value at the time of exercise, in which is known as non-qualified stock option. Again, ordinary income is used to tax the difference between the exercise price and the fair market value at the time of exercise, which is known as non-qualified stock option. ISOs are only given to employees. So we are still working on the comparison between ISOs and NSOs. ISOs are only given to employees. NSOs are available to both employees and non-employees, like consultants, board of directors, and contractors. ISOs may be subject to the alternative minimum taxes if the stock is not sold in the same year it is exercised. AMT, alternative minimum tax, is not triggered to NSOs and SOs, non-qualified stock options. In order to receive favorable tax treatment, ISOs must meet certain holding periods. The favorable stock treatment for NSOs, non-qualified stock option, does not require a specific holding period. Now I'm going to present the difference between grant day, exercise day, and sale day. It is very important to understand, because based on this understanding, you will determine the capital gains and losses, either short term and long term. What is a grant date? When the company grants stock options to employee, this is what happens. What is exercise date? When the employee chooses to utilize their stock option and acquire shares at the strike rate. What is the selling date? When the employee decides to use their stock options and buy shares at the strike price. What is the ESOP? Employee stock ownership. Employees have the option to contribute to a fund that consists of common stock in their employer. Through ESOP, the employer stock is given to ESOP participant after retirement. Income is recognized when distributions are made in ESOP. So income is recognized when distributions are made from the ESOP stock basis. The excess fair market value of stock over the ESOP basis is not subject to tax. I thank you so much for staying with me and listening and watching this video. Again, I thank you and God bless you.